Hey guys, I thought I would do a 6 investing mistakes to avoid video. Thought I'd split this up into two because there's quite a lot to go through. So part one today and part two next week. Obviously, I'm not any sort of guru. It's from my experience. I've made some of these mistakes myself, and from seeing various other investors and talking to people on various forums. I can sort of see that this could be something to think about. But as I say, I've sort of made some of these myself, and maybe you can sort of learn from my mistakes as well. So something quite common, I would say, is sort of chasing a loss. So this sort of interesting chart, obviously the escalating amount you lose, it takes so much more to get it back. So if you lose sort of 10% on a stock, you're pretty much 11% just to recover that money. So it's not too bad. But when you start losing sort of half your money in a stock, you've now got to double your money. You're not gaining 50% to gain your money back. And sort of as you go down the chart, if you have a sort of complete catastrophe, if you lose 80%, you now need a 400% return to get your money back. And sort of a lot of what people will end up doing is sort of maybe selling off what they were invested in, but sort of fixating on the amount that they had. So they'll then be reinvesting it somewhere else aggressively to sort of try and get this 400% return if you've lost 80%, say. So this can mean going for sort of penny stocks, maybe, sort of small cap, growth stocks, tips that you hear just because they're sort of fixated on the amount that they had. Say you had £1,000 sort of invested in something, it's gone to £200, say, on this sort of 80% loss, and you're wanting to try and turn that £200 back into £1,000, which is sort of going to be quite unlikely. So a lot of people, this isn't sort of to pick on any one company, but sort of see a lot of people talking about this company's skills sort of middle of last year as sort of a tremendous growth company. They probably are growing, looking at their sort of revenue. Yeah, so they've grown revenue, 7, 8 times. And yeah, the stock sort of has dropped 80, 90%, which it's a risky company, and we're sort of potentially going into a recession. So they're hardly alone, but it's this mentality of trying to, as I say, you're down to £200, trying to make back that £1,000 by sort of investing too aggressively to get there, where you can sort of just accept that you've lost £800, say, reinvest the 200 back into sort of something steady, legal and general, for example, and just accept that you're going to get 7, 8% return on that sort of £200, but not sort of fixate too much on what you had before. Essentially, like sort of being down at the horse racing, people sort of lose 3/4 of their money, and then they sort of try and spend the remaining quarter to get back that 3/4 that they lost. So they'll put it on a very risky horse, for example, and it's very, very unlikely to pay off. So you just lose the remaining quarter as well. So yeah, I do see that as a mistake. So I think the next one probably is averaging down for the sake of it. So this is something that I was a little bit guilty of with ASOS. So I was sort of buying them in the sort of £35 range, sort of dropped down to 30, and sort of just almost immediately I put a fair bit more into average down. So this was sort of Obviously, it's got a lot worse with the inflation continuing, shipping costs going up, oil going up, and then the war has sort of pushed things worse as well. And yeah, so then sort of it's come down to £15, say, and it'd be very easy to sort of think, well, I'm down 50 odd percent, so I will average down sort of without really re-looking at the company sort of on a fundamental basis and sort of seeing where you think they're going to be in the next 2 or 3 years. So, I mean, ASOS could easily recover back to what they've been at and potentially go to new highs over the next sort of 3 to 5 years. But I think you have to sort of forget that you've bought, basically, treat it as a completely new stock, and sort of assess what you think they could be doing over the next few years. Personally, I sort of don't see the inflation going away completely right away, so I could sort of see this being a fairly very low margin business sort of going forward, which isn't really sort of something that I'd want to be in. So they're growing revenue, but can't see them growing sort of profits at a rate that I would want them to. So I sort of looked at it at £15. Thought not really all that happy sort of going forward. I think there's better value elsewhere. So I decided to sell it at 50% down. But it's very easy to just sort of look at it as 50% down. I'll average down on it, try and bring that average cost down, and then sort of when it goes up, not if it goes up, when it goes up, then it'll take less for me to regain that profit. So yeah, averaging down sort of for the sake of it and not because you're sort of still bullish on the company, I would say is a bit of a mistake. So next is recency bias, I would say. So a lot of people do seem to be sort of fixating more on the Nasdaq than the S&P at the moment. And yeah, so you look sort of since November, December time in the sort of the peak, we're down about 23-24%. Looking at today's prices, and yeah, this could go down further, and people are sort of seeing this as it must be a tremendous buy. Let's pile in, whether you're in ETFs or individual stocks. People sort of look at the Nasdaq as a comparison to their individual stocks, but you've only really got to zoom out sort of not all that far. I mean, you look down to sort of 2018, we had about a 20% drop sort of in a couple of months, really, based on sort of much less than we're having at the moment. So 20% drop really isn't all that much. It can be it can happen for far less reasons than we've got now. You've got the sort of pandemic drop there, sort of 30% in very quick succession. That was a fair drop, or a drop for a fair reason, I would say. And then obviously we had the money printing and everything started. But yeah, if you look sort of further back on a logarithmic chart, it can sort of show you a little bit better in sort of scale how much this drop is. So this is sort of since the peak in sort of November, December time, and that's the amount of the drop. So when you compare it to sort of previous bear markets, sort of the global financial crisis in 2008, you're looking at sort of 55% on the Nasdaq from sort of top to bottom. You don't even have to take the peaks. You're looking at sort of 50% from the rough high to sort of the rough bottom, and sort of even worse with the sort of dot-com bubble. Again, you don't have to take this sort of absolute peak. You can sort of take the little sort of shelf that we were on for 4 or 5 months afterwards. again, people will be thinking it's already dropped 25-30% and sort of recovered a little bit, and sort of you might think that's over, and obviously then over the space of sort of a year and a half you get another 75% drop. So, and you can go way back obviously on the indexes and sort of see various other drops, but yeah, I think it's very easy to sort of look at the last few months and think, well, that must be it. We're in bottoming territory where, if you, as I say, if you look on a sort of percentage drop basis, then yeah, it's not quite that bad. It is important, I would think, to look on the sort of logarithmic charts or a percentage-based chart rather than just a standard chart, because that can make it look a lot worse. Because obviously in plain number terms, it is a 4,000 point loss, where previous drops won't have been a 4,000 point loss because they were much smaller numbers back then. So always put your charts on either sort of logarithmic, if it's available, or percentage based, just to sort of see the severity really. The S&P sort of had a similar but sort of slightly different move. Didn't have quite as much of a peak in the dot-com bubble. Very similar in the global financial crisis, but yeah, the drop sort of recently is much less on sort of percentage terms. Even in real terms, actually, it's only sort of 15% odd, sort of 16-17%, I think. And obviously on sort of a PE ratio basis, we are not back down to the averages yet. So sort of for basically the whole of the last century, we were sort of averaging about 15 PE ratio. Again, we've come down from the peak, but we're still at sort of 26, 25. Again, a lot of people will sort of look at the Nasdaq especially and the S&P and sort of say that the sort of FANG stocks and big tech stocks are holding it up, which would be a fair point. But you've only got to look at sort of say a Vanguard mid-cap growth stock. So this wouldn't be including any of the sort of big tech and FANG stocks. This would be sort of your $10-20 billion companies, and sort of since the peak, that is only down about 30%. So 23 on the Nasdaq, 30 on the sort of mid-cap growth. So it's not sort of horrendous when people say, they'll show these charts of the percentage of companies that are down since the peak, and sort of it can make things look an awful lot worse. But when you look at the indexes, it's not that bad. Vanguard small cap growth, very similar, 30% down from the peak. So yeah, there's certainly I would say a lot further we can fall. I think people are sort of probably drawn to these sort of very high growth companies that have dropped an awful lot, and they'll sort of project those losses onto the market, which is easy to do. You sort of, if you're in any of these stocks that are down 60, 70, 80%, then you sort of look at the market and you sort of, as I say, project those losses onto the market basically, and think, well, we must be at a bottom because the market has crashed, when really it is just sort of not a small group of stocks. It is, I would say, still quite a lot, but there are quite a lot that sort of aren't doing so bad, which would be the reason the indexes still haven't dropped yet. As I say, both of these are excluding big tech and the FANG stocks, and there must be obviously a lot of other stocks in there that are balancing out the big losses. So unfortunately, I still say we've got quite a bit further to go. So yeah, that's part one. join me again next week for part 2 of sort of mistakes to avoid. So like and subscribe, and see you soon.